Steve Sosnick here with today's Interactive Brokers Midday Market Update for Wednesday, August 19th, 2020. Another day, another rally, not a particularly big one, at least at this point, but the trend continues to be upwards and there really doesn't appear to be much disrupting the trend, and so here we go. This is a day where sort of the inevitabilities happen. It was inevitable. The market was so focused on the Fed making an all-time high. Once we got close, it became inevitable, and we got it yesterday. We became focused on Apple being the first $2 trillion U.S. company. Seemed inevitable. Guess what? We got there. This is what happens when you just have trending markets with mediocre volume. In the summer, all kinds of things can happen, and we go from there. And this is what we see. What's very interesting was I was doing a little work on volatility, and this is one of those. This is one of the things that one might want to keep in mind. Historical vols are very low right now. I guess that's to be expected. We just seem to go up mildly every single day. So why would there be much volatility? So the 10-day historical, and I'm going to use SPX here, so just bear with me. The 10-day implied vol for SPX is below 10%. And when using the rule of 16, which I've explained various times, that's well under 1% a day movement. It's a little higher when you start to do it intraday. That the historical vols are close to close, but still in all, there's really very little movement, and so we're looking at about a 10 there. The implied vol on the near-term SPX options is about a 16. So that's a pretty big premium. Again, it should be a little higher because there was, partially because of the difference between close to close and intraday high-low volatility. Remember, traders trade off of a high-low volatility. If you're moving up, you're moving down, and you close unchanged, well, you still had a chance to monetize your gamma. To monetize your position, if you're hedging, if you're delta hedging, you've been incentivized to buy low, sell high. if you're long the gamma. Sorry, I'm getting really into the weeds here, but basically, so the high-low vol is what's more relevant. It's always going to be a little bit higher than close to close because it's rare that we close it at one extreme or the other. So that's part of the divergence, the 16 versus the 10. And then we start to look at the VIX, which is 21.5, give or take now, as we're taping this. And there's something important to keep in mind. The VIX is 30 days out. So spot VIX is really a 30-day measure. So what we're saying is historical vol is about a 10 or below. Implied vol is about a 16 near term. Looking out 30 days, we're starting to look at about a 22. And looking out even beyond that, we're starting to get to 25 and 28 as we get into October futures. Remember, the October right now is the highest because that's election. And again, going back to the fact, always keep in mind, VIX is looking 30 days out. It's not looking at the nearest term options. It's looking at a range of options between, I think it's, I don't have it in front of me, call it 24 and 38 days around the 30-day volatility. So around the 30-day number to keep that number steady. So what you end up with is a 30-day look ahead. Looking ahead from October, you're looking at November. Remember, VIX futures for October, VIX futures expire mid-October. 30 days beyond that includes election. The vols remain very firm, pretty much through inauguration. Again, we're looking at some interesting scenarios. There's one scenario which is I've heard as high as 50-50. I've heard relatively lower. Is that the Democrats capture the Senate as well, which would certainly make it easier for any people who are fearing higher taxes to see them, and among them is capital gains taxes, which Biden has said very clearly that he would raise them up to match income. When you hear about a threat of a capital gains tax, people often are incentivized to sell their stocks, sell their winners to pay the lower rate. So you may see that kind of action if you see the Democrats take the Senate. So that's part of the VIX that's being priced in. And for the first time, certainly in my lifetime, there's a president who has said that he is not necessarily willing to accept the results of the election. Talk about a major volatility event. If there's any sort of contested election, which is not something we've seen in the US, even Bush Gore was contested, but both sides had sort of agreed that they would accept the results. We've never seen anything of this nature, and that would be unprecedented. And that's why you see VIX remaining firm throughout pretty much February, starts to decline into March. So you have this weird curve with a steep front and an inverted back. It's very unusual. But let's focus on the shorter term, and that is the fact that the equity markets, the cash markets seem rather complacent right now, but the option markets display a lot less complacency. And we've gone through the reasons for that before. I'm not going to belabor all of them, but bear that in mind and start to wonder, are the option who's right in this scenario? Is it the cash guys who are just, who just see a market that goes up every day and are quite happy with it, and understandably so? Or is it the options guys who have to worry about where hedges go in and whether they're seeing demand for option protection in what can be a seasonally challenging time, September through November of an election year? Let's see. Have a good one, everybody.